Car Finance Glossary. There is an awful lot of jargon involved in car finance, which makes it tricky to get your head around the facts and what's the best option for your circumstances. We have put together a list of key terms that are used within the car finance process. Treat the following list as your essential guide to understanding car finance jargon. APR, annual percentage rate. This is the rate of interest and charges you'll pay over a year, on top of your actual loan amount. The lower the APR percentage, the better it is, as you will be paying less each month. Arrears, money that is owed and should have been paid earlier. Conditional approval, your loan has been assessed and approved, in principle at least, though the lender needs more information before you can be granted formal or unconditional approval. Credit agreement is a legal document that outlines the terms of your loan between you and the lender. The creditor is legally required to provide a credit agreement and it must be signed by both parties. Credit rating. This is a rating or score that assesses the factors that will affect your ability to manage your debts. Your credit rating is used by lenders to assess the risk of offering you credit. It's calculated based on information in your credit report, such as your recent address history and any outstanding credit cards and loan balances. Default. Failure to fulfil an obligation, especially to repay a loan. Deposit. A lump sum paid up front to secure the sale of a product or service. When you take out car finance, you may be required to pay a deposit depending on the type of agreement. Depreciation. A reduction in the value of the asset over time, due in particular to wear and tear. Early settlement. When you pay off a credit agreement early under the Consumer Credit Act, the total amount you pay is reduced. Equity. Equity is the difference between the value of the vehicle and the amount owed on the loan. For example, if your car is worth £10,000 and you have a balance of £4,000 owing, you have £6,000 in equity. FCA. The Financial Conduct Authority is a financial regulatory body in the United Kingdom, but operates independently of the UK government. Fixed rate. This is where the interest rate on your loan doesn't vary. This makes predicting your repayments more accurate. Flat rate is a percentage of interest charged on the initial loan amount every year you have of the loan. With a flat rate, the interest is charged on the original amount of your money you borrowed and doesn't take into account what has been repaid. Hire purchase, also sometimes known as HP, is that you pay to hire a car over a period of time before actually having paid enough to own it outright. HPI check. This vehicle check provides information to ensure the vehicle you want to buy isn't already financed and owned elsewhere. Interest rate. This is the price added on top of the money you borrow. Joint application. When you apply for joint car finance with another person, using both your personal details to support your application. Lending criteria. Financial characteristics the lenders look at when deciding whether to lend to you. Negative equity. When the current value of your car is less than the amount needed to pay off the finance on it. Option to purchase fee is an optional fee when it's applicable only if you purchase the car. The finance company will charge this fee at the end of the term. You need to pay this fee to transfer the vehicle legally to your name. Part exchange is when you trade in your current car and put the proceeds towards the purchase of your new vehicle. Secured loan. This is where a lender will take an asset should the loan not be paid. For example, if your loan is secured against your car, the lender has the right to repossess the car should you default on payments. Settlement. The amount you continue to owe on the sum you have borrowed, plus interest. Term. The length of time you need to pay back your loan. Total amount payable. Total amount payable is the overall amount paid to purchase a car through a finance agreement, including interest. Voluntary surrender. Under a voluntary surrender, you give back the car but still owe whatever is left to pay. Voluntary termination is the legal right of a borrower or customer to cancel an agreement early. It means returning the vehicle and then only being liable for half of the overall agreed finance amount. Wear and tear. Damage that naturally and inevitably occurs as a result of normal everyday use or ageing of the vehicle. For more information on car finance, visit www.gocarcredit.co.uk.